Welcome to Business with Louis, the show where we dive into the world of entrepreneurship and explore the concepts that can help you succeed. Today, we're talking about tax-efficient investment strategies, a crucial topic for anyone looking to optimize their wealth and achieve their financial goals. So, what are tax-efficient investment strategies? In simple terms, it's an approach to investing that takes into account the tax implications of your investments, with the goal of minimizing taxes and maximizing after-tax returns. This concept is essential in the world of business and entrepreneurship because it can help you keep more of your hard-earned money and make the most of your investments. The origin of tax-efficient investment strategies dates back to the early days of investing, when investors first began to consider the impact of taxes on their portfolios. Over time, this concept has evolved to incorporate new tax laws, regulations, and investment products. Influential thinkers such as Benjamin Graham and Warren Buffett have also contributed to our understanding of tax-efficient investment strategies. One key principle is the idea of tax-deferred growth, which means allowing your investments to grow without paying taxes on the gains until you withdraw the funds. This can be achieved through tax-deferred accounts such as 401s or IRAs. Another important concept is tax loss harvesting, which involves selling losing investments to offset gains from other investments and reduce your tax liability. Our understanding of tax-efficient investment strategies has evolved significantly over time, thanks to advances in technology, changes in tax laws, and the development of new investment products. For example, the introduction of index funds and ETFs has made it easier for investors to diversify their portfolios and minimize taxes. Additionally, research has shown that a tax-efficient investment strategy can add significant value to a portfolio over the long term, with some studies suggesting that it can increase after-tax returns by as much as 1–2% per year. Let's look at some real-world examples of tax-efficient investment strategies in action. One notable example is Warren Buffett's investment strategy, which emphasizes long-term investing and tax-efficient planning. Buffett has said that he aims to pay the lowest tax rate possible on his investments, and he achieves this by holding on to his stocks for long periods and using tax-deferred accounts to minimize tax. Another example is the investment strategy of Peter Lynch, who is known for his successful tenure as manager of the Fidelity Magellan Fund. Lynch has said that he uses a combination of tax loss harvesting and tax-deferred growth to minimize taxes and maximize after-tax returns. He also emphasizes the importance of diversification and long-term investing in achieving tax-efficient investment goals. First, it's essential to understand your tax situation and investment goals. Consider working with a financial advisor or tax professional to develop a customized plan that takes into account your income, expenses, and investment objectives. One practical tip is to prioritize tax-deferred accounts, such as 401s or IRAs, for your retirement savings. Another strategy is to focus on long-term investing rather than trying to time the market or make quick profits. It's also important to stay informed about changes in tax laws and regulations that may impact your investment decisions. For example, the Tax Cuts and Jobs Act of 2017 introduced significant changes to the tax code, including a new 20% deduction for qualified business income. By staying up to date on these developments, you can adjust your investment strategy to minimize taxes and maximize after-tax returns. In addition to these strategies, it's crucial to be aware of common challenges that investors may face when implementing tax-efficient investment strategies. One challenge is the temptation to try to time the market or make quick profits, which can lead to unnecessary taxes and reduced returns. Another challenge is the complexity of tax laws and regulations, which can make it difficult to navigate the landscape. To overcome these challenges, it's essential to stay disciplined, focus on long-term goals, and seek professional advice when needed. In conclusion, tax-efficient investment strategies are a powerful tool for entrepreneurs and investors who want to optimize their wealth and achieve their financial goals. By understanding the core principles, models, and frameworks that underlie this concept, you can make informed decisions about your investments and minimize tax liabilities. Remember, every great business starts with action, and by applying tax-efficient investment strategies, you can take control of your financial future. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.